Hi traders, if you have ever found yourself stuck in a trade with price going nowhere or getting caught in unexpected volatility, chances are that you have been trading in bad market conditions. And trust me, every trader faces this at some point. Now, in this video, I'll break down how to avoid trading in bad market conditions, the key signs to watch out for, and when it is better to just stay out of the market. All right. Avoiding bad trades is just as important as finding good ones. So if you are serious about improving your trading game, make sure to hit that like button, subscribe to the channel, and turn on notifications so you never miss an update. All right, let us just get into it. First up, we have choppy and ranging markets. Okay, we have choppy and ranging markets. You can see what we have happening around here. Right? These are the worst for most traders when the market has no clear direction, just moving sideways. Because the price moves erratically with no real direction. So you'll see random spikes up and down, but no trend to follow, no strong trend to follow. What's the problem? These markets will trap you in false breakouts and stop you out repeatedly. So instead of clean trend movements, price just whipsaws back and forth. So how do you avoid it? Look for a market that is clearly moving in one direction. Okay, when you want to trade, just find a trending market and ride the trend. It's as easy as that. Okay, when you notice price moving sideways, it's better to just stay out of the market. All right, just identify a market where lower lows and lower highs are being formed, or where higher highs and higher lows are being formed. Okay, this is what we call trending market. If you see price bouncing between a tight range with no real progress, step aside and wait for a breakout with confirmation. Next, we need to talk about low volume and liquidity. Okay, when market participation is low, spreads widen, price moves sluggishly, and executions become unreliable. Now, low liquidity often happens during holidays, late hours, or before big news events when traders are waiting on key information. The danger here is that price can suddenly jump due to a lack of orders, leading to unexpected moves or unpredictable moves. So how do you avoid this? Always check the trading volume and the session you are trading in. All right, it is important to check your volumes, check the trading volumes and the session that you are trading in. Okay, the London and New York sessions have the most liquidity, while early Asian sessions tend to be slower. Avoid trading when volume is low and wait for high participation hours for better setups. Now, one of the fastest ways to get wrecked in forex trading is during high impact news. All right, that's one of the fastest ways to get wrecked in forex when you trade during high impact news events. Now, this can cause extreme volatility, right, leading to wild price swings. In fact, as at the time of recording this video, we had a recent let's just let me zoom out. We had a recent news. I think that was the CPI that occurred on the 12th of February. Okay, so we can see, I think this should be the time that it happened, because this long candle, this spike to the downside, this fall, this sharp fall, I think it was as a result of the news. So during periods of high impact news events, you will notice that there's usually high volatility. You can see just shortly after this downward move, you can see how the whole sell move was erased completely by this this upward move, and you can see that eventually the price went up. Okay, so if some traders had thought that the price will continue going down, they would have been stopped out. If perhaps if you had set a stop loss around here. So that is the reason why trading during high impact news events, you need to be very careful, because the market can be quite erratic during that period. So events like central bank decisions, non-farm payroll reports, and inflation data can cause price to spike hundreds of pips in seconds. So if you are in a trade, you might get stopped out instantly or face massive slippage. To avoid this, always check an economic calendar before trading. Okay, if a major news event is coming up, step aside and wait for the dust to settle before making any moves. Now, another dangerous situation is overextended trends and fake breakouts. All right, this happens when a trend has been running for a long time. We have a good example in gold. In as much as, yes, gold is still very much bullish at the moment, but we have quite an overextended trend. The last time we had a notable pullback was this was the last time we had a notable pullback. That was December 2024. In fact, it was around middle of December 2024. So that's over 2 months, or well, roughly 2 months ago. So roughly 2 months ago was the last time we had a notable pullback. In as much as gold has been in an upward trend for how many years now? I think that should be like 2 years. Yes, since 2022. Okay, this should be the third year that gold has been. Yeah, this was ending 2022. So since 2022 till now, being 2025, gold has been on a consistent upward trend. But you will notice that there have been pullbacks, because price does not move in a straight line. So there has been pullbacks, right? But right now, we have quite an extended upward move without a significant pullback. So this is just an example. I'm just trying to show you an example of an overextended, upward move. Yeah, in as much as gold is bullish at the moment, right? It's still quite bullish, right? But it is quite risky at the same time to jump in for a buy at this high level when a significant pullback has not yet occurred. And this is the daily time frame. Okay, I'm not saying that the price cannot just keep on going up and up and up and until it gets to 4,000 and the rest of that. Well, it's just an assumption though. But so to be on the safer side, if you want to buy in this kind of situation, you should exercise extreme caution. Yeah, because you are literally buying at high prices. So the ideal thing is to wait for a pullback and then you can now buy, right? But if you want to take the risk of buying at such a high price without a significant pullback yet for this buy trend, then you have to exercise extreme caution, right? So in situations where you have overextended trends and false breakouts, your false breakout is where price perhaps you have a range. Yeah, you have a ranging market. Let's see if we can find one around here. Okay, I think we have one around here. It could be a ranging market. It could be, perhaps price was forming a pattern, and then price breaks out. You can see in this situation, price breaks out below. Ideally, some traders might be thinking that the sell was going to continue, but you can see that we had the price climb back up into the range and in fact broke out above, and you can see what happened along the line. So when you notice a false breakout, just patiently wait for the next course of action. Patiently wait for the next price action that's going to be exhibited by the currency pair before you get in. All right. Okay, so now one of the realities of this is that big players often use these moments to trap retail traders before reversing the market. Price may push slightly higher or lower, triggering stop losses, then quickly reverse in the opposite direction. So how do you avoid this? You can use momentum indicators. Well, you can use momentum indicators like the RSI and the MACD, okay, to check if a trend is losing strength. However, these indicators do not guarantee profit, right? They are not 100% accurate, okay? But you can just use them for confirmations, okay? If the market is heavily overbought or oversold, you have to be cautious and look for reversal signs before entering a trade. All right. Lastly, beware of the market open and close traps. These are the first and last hours of major trading sessions when volatility is high, but price movements can be erratic. Okay, so at market open, price may spike in one direction before reversing sharply. Okay, similarly, at market close, traders may exit positions, causing random price swings. So pay attention to that. Okay, if you are trading around these times, wait for the first 30 to 60 minutes to pass before entering a trade. Okay, let the market establish a clear direction first. All right, let's just do a quick recap. Here are 5 bad market conditions to avoid. The first is choppy or ranging markets. All right, you should avoid choppy or ranging markets. Okay, no clear direction, a market that does not have a clear direction, or just whipsaws, you should avoid that. Okay, and then avoid trading during low volume or low liquidity. All right, during periods of low volume and low liquidity, there is usually poor execution, wider spreads, and unpredictable moves. Okay, and the next is major news events and high volatility, because there's usually sudden spikes and erratic price action. The fourth, bad market condition to avoid is overextended trends and fake breakouts. Okay, because late entries get trapped before reversals, right? And then the fifth is market open and close traps, because wild movements before direction, is usually exhibited, right? There's usually some wild movements before a direction is established. So have you ever been caught in one of these bad market conditions? Let me know in the comments below. And before you go, don't forget to hit that like button, subscribe to the channel, and turn on notifications so you never miss my next trading guide. In the meantime, thank you for watching and happy trading.